Welcome to L-Impact Solutions. First finance news today. The recent initiative by China to clean up local finances is a pivotal moment for its economy, especially concerning state-owned enterprises, SOEs. This move stems from a need to address long-standing issues of inefficiency and corruption that have plagued these vital components of the Chinese economy. For businesses engaged in or closely monitoring the Chinese market, understanding the implications of this financial cleanup is essential. It can not only reshape the landscape in which these companies operate, but also present fresh opportunities for growth and collaboration. In recent years, concerns about the financial health and governance of SOEs have come to the forefront. Analysts have pointed out that local governments often have a tenuous grip on the financial operations within their states, leading to a degree of opacity that has not only created turbulence due to fluctuating market conditions and ongoing geopolitical tensions, has made a compelling case for the government to take action. The reform of SOEs has the potential to create a ripple effect throughout the economy, impacting various business sectors. A more transparent and accountable framework could lead to improved operational efficiencies, which might result in reduced costs and expanded profitability for companies that interact with these entities. Think about how this could transform the opportunities available for businesses. Firms looking to enter or expand within the Chinese market might find that the changes not only create a more robust environment for investment, but also foster collaboration with SOEs that are now under greater scrutiny. Instead of approaching these enterprises with skepticism, businesses could engage them as partners in innovation, sharing best practices and technologies that drive not only profits but also societal good. Moreover, this cleanup operation could serve as a catalyst for broader reforms throughout the entire public sector in China. If local finances are cleaned up and SOEs are held to higher standards, this could encourage other sectors to follow suit. For businesses that depend heavily on government contracts or work closely with public institutions, this shift could mean a change in bidding processes, compliance requirements, or even how contracts are negotiated and executed. Companies may find new opportunities for engagement as the Chinese government emphasizes partnerships with the private sector, seeing them as critical players in achieving national goals. Investor confidence, in particular, is a critical component of economic growth. The reforms planned by the Chinese government could significantly alter perceptions of risk among foreign investors. The certainty that comes from knowing that the financial practices of SOEs are subject to intense scrutiny and reform could attract a significant inflow of foreign capital. For businesses, this influx can lead to new avenues for funding, partnerships, and technological exchanges that can drive expansion and innovation. Additionally, when considering the global context, the cleanup of local finances and the reform of SOEs could position China more favorably in an increasingly competitive international market. As more investors express their willingness to engage with a nation that demonstrates accountability, China can enhance its appeal as a destination for business. This could create a cycle of growth that encourages even more transparency and reform, thereby potentially leading to a healthier, more resilient economy. There's also the element of social responsibility that companies must increasingly be aware of. The reform initiative suggests that the government is not just focused on economic metrics, but is also concerned about the overall social impact of its enterprises. As businesses align themselves with these reforms, there's an opportunity to enhance corporate social responsibility initiatives, thereby improving their brand image and consumer perception. A business that engages with more accountable state firms can position itself as a leader in ethical practices within its industry, which is increasingly valuable in today's markets where consumers are seeking more ethical choices. However, as we delve deeper, it's important to note that such sweeping changes also come with their own set of challenges. Companies must be agile in adapting to new regulations and changes in how business is conducted. Those that are willing to invest in understanding the new landscape and modifying their strategies accordingly will likely emerge ahead of the game. Flexibility and foresight will be key attributes for successful businesses in this evolving environment. As the cleanup of local finances unfolds, it's vital for businesses to stay informed and engaged. This initiative can lead to enhanced communication channels between state firms and the private sector, fostering an environment where information flows more freely, promoting collaboration based on shared goals. Moreover, this opens up avenues for businesses to influence the legislative landscape by advocating for fair practices and transparency standards that benefit both the public and private sectors. Furthermore, stakeholders who have traditionally viewed China through a lens of caution may start to recalibrate their perspectives. As the reforms take root and demonstrate tangible results, the narrative surrounding investment in China could shift from one of uncertainty to one of opportunity. This could be particularly appealing to venture capitalists and startups looking for markets with growth potential while ensuring that their investments are shielded from the risk of corrupt practices. In essence, while the immediate implications of the cleanup may be focused on SOEs, the broader economic environment will likely feel the effects in various sectors. Businesses that proactively engage with the changes can leverage them to bolster their growth strategies, maximizing opportunities that arise while mitigating risks associated with the previous climate of uncertainty. This cleanup initiative also speaks to a larger trend where economies globally are adapting to the demands of modern governance and business practices. The emphasis on transparency, efficiency, and responsibility is not solely a Chinese phenomenon, it is a global one. For businesses operating across borders, this serves as a vital reminder of the evolving nature of corporate governance and the need to adapt to ensure competitive advantage. News number 2, GemmaBio's recent achievement of raising $34 million in seed funding is an exciting development in the biotech landscape and serves as a testament to the innovation brewing within the health sector. This significant influx of capital not only emphasizes investor confidence in GemmaBio's vision and technology, but also highlights a broader trend of increasing investment in biotechnology. For those involved in this space, whether as entrepreneurs, investors, or industry professionals, understanding the implications of this funding round can provide valuable insights into future opportunities for growth and collaboration. Securing $34 million in seed funding is no small feat, especially in a competitive market where the biotech sector has seen its share of ups and downs. This funding will allow GemmaBio to accelerate its research and development efforts, which is crucial for any startup aiming to establish itself in the health sector. The biotechnology field is characterized by its complexity and the lengthy path to product development, often requiring years of research, rigorous testing, and significant financial investment to bring a viable product to market. Therefore, having substantial funding at this early stage can be a game changer, providing the resources necessary to navigate these challenges effectively. The health sector is in constant flux, driven by emerging technologies, evolving patient needs, and the complexities of healthcare systems worldwide. GemmaBio's innovative technologies promise to disrupt traditional healthcare models, which is something investors are keen on supporting. This disruption often translates to improved outcomes, higher efficiency, and potentially lower costs in healthcare delivery, which are all key factors that resonate while during discussions with investors seeking promising opportunities. GemmaBio's approach to addressing healthcare concerns invites a fresh perspective, potentially paving the way for solutions that traditional methods may have overlooked. As GemmaBio channels this funding into R&D, its focus will likely be on developing products or platforms that address significant gaps in the healthcare system. This could involve anything from new drug discovery processes to advanced biomanufacturing techniques, or even digital health solutions that leverage big data and artificial intelligence to provide personalized care. Whatever the focus, the foundation laid by this seed funding will be integral to advancing GemmaBio's mission and ultimately enhancing patient care. From an investor's standpoint, funding a biotech startup like GemmaBio represents more than just a financial transaction. It signifies a belief in innovation that can lead to transformative change in health outcomes. The continuing evolution of healthcare demands solutions that are both cutting-edge and accessible. Investors are increasingly aware that companies like GemmaBio, which are prepared to tackle these challenges, offer not only significant potential returns but also the opportunity to make a substantial impact on public health. In raising such a considerable sum, GemmaBio now stands at a pivotal moment. The pressure to deliver results is real, but so are the opportunities. By utilizing this funding wisely, GemmaBio has the chance to shorten the timeline from concept to commercialization, allowing it to potentially become a leader in its niche within the biotech sector. This is crucial, especially considering how vital speed and adaptability are in a rapidly changing industry. Moreover, the speed at which a biotech company can move from idea to market can often determine its survival in a crowded landscape. Collaboration will also play an essential role in GemmaBio's journey. Engaging with established players in the industry, including other biotech firms, pharmaceutical companies, and academic institutions, can accelerate innovation and enhance R&D efforts. Partnerships can provide not only additional resources and expertise, but also valuable networks and insights that can contribute significantly to the success of GemmaBio's technologies. As the company progresses, forming strategic alliances may open doors to new markets and applications for its products, which is vital for scaling its operations and achieving long-term growth. Furthermore, the success of this funding round underscores a growing trend of venture capital pouring into the biotech industry. Investors are becoming increasingly enthusiastic about supporting innovative health solutions, especially in light of recent global health challenges that have brought the importance of effective healthcare systems to the forefront. The COVID-19 pandemic has exposed vulnerabilities and inefficiencies in traditional healthcare approaches, prompting both investors and innovators to rethink existing models and explore new avenues for enhancing health outcomes. For aspiring entrepreneurs within the biotech sector, GemmaBio's success story serves as a beacon of what is possible with the right combination of innovation, funding, and strategic vision. The interest from investors highlights the appetite for groundbreaking ideas that can address unmet medical needs. Startups aiming to enter this competitive space should take note of the importance of having a solid business model and a clear path to commercialization, as these elements are crucial for attracting investment. Long-term growth in biotechnology often hinges on the ability to effectively convey how the technology will work, whom it will benefit, and how it fits into the existing healthcare ecosystem. GemmaBio's ability to attract significant funding suggests that its team has articulated a compelling vision, demonstrating not only what they want to achieve but also how they plan to get there. For other biotech companies, developing this narrative is essential to gaining traction and investor support. As GemmaBio embarks on this journey, the technology landscape in healthcare will continue shifting. The integration of artificial intelligence, machine learning, and data analytics into health solutions promises to enhance various aspects of patient care, from diagnostic processes to personalized medicine and even patient management. Keeping a pulse on these trends will be critical for GemmaBio as it develops its technologies, ensuring they remain relevant and effectively address the evolving needs of healthcare providers and patients alike. In light of these developments, it's clear that the $34 million in seed funding has set the stage for significant advancements at GemmaBio. The support from investors not only validates the company's current endeavors, but also positions it for future success in the dynamic field of biotechnology. The emphasis on innovation and disruption within traditional healthcare models is bound to pave the way for a transformative impact, benefiting both the industry and the patients it serves. As the company progresses, it will be fascinating to observe how it navigates the complexities of the biotech landscape, builds upon its funding success, and ultimately strives to leave its mark within the health sector. Opportunities for collaboration, innovation, and disruption await, making GemmaBio a company to watch as it sets out to create meaningful changes in healthcare through its pioneering technologies. This journey emphasizes the critical interplay between funding, innovation, and ultimately, the realization of a healthier future for all. News number 3. In the financial services, the advent of digital IDs represents a significant shift towards a more secure and efficient future. Financial institutions are increasingly recognizing the importance of robust identity verification systems to combat the rising tide of fraud and cybercrime. As banks team up with tech companies to implement these digital identification solutions, they are not only enhancing their security measures, but also fostering greater customer trust in the financial ecosystem. Digital identities have emerged as a crucial tool in the fight against fraud. Traditional methods of identification, such as physical IDs or in-person verification, can be cumbersome, slow, and, frankly, vulnerable to manipulation. In an age where most transactions occur online, the need for a more streamlined and secure method of identity verification is paramount. By leveraging digital IDs, financial institutions can verify identities more accurately and efficiently. This means faster onboarding processes for new customers, reducing friction during account creation or loan applications, and ultimately enhancing the overall user experience. Collaborations between banks and technology companies are key to advancing this initiative. These partnerships are designed to harness the strengths of both sectors. Banks bring their vast experience in compliance and customer service, while tech companies provide the innovative solutions necessary to create secure and user-friendly digital identity systems. Together, they can develop protocols and tools that meet regulatory requirements, anticipate potential vulnerabilities, and adapt to emerging threats in real time. For consumers, this implies a more seamless interaction with financial services, where identity fraud becomes a significantly reduced risk. When financial institutions adopt digital IDs, they also gain access to a wealth of data that can be used to bolster security measures. For instance, advanced technologies such as biometrics, artificial intelligence, and machine learning can help create a comprehensive profile of a user's identity. These technologies allow for continuous monitoring of user behavior, quickly identifying any anomalies that could indicate fraudulent activity. Anomalies might include a customer suddenly attempting to log in from a different geographical location or unusual account activity that deviates from established patterns. In such cases, financial institutions can respond swiftly, either by blocking the transaction or prompting additional verification steps to ensure the customer's identity. The move towards digital IDs not only strengthens security but also enhances customer trust. With news of data breaches and identity theft making headlines regularly, consumers are more cautious about where and how they share their personal information. By adopting secure digital identity solutions, financial institutions can reassure their customers that their sensitive data is protected and that the company is taking proactive measures to prevent fraud. This reassurance is vital in building long-term customer relationships, as trust is foundational to the success of any financial service provider. Moreover, the implementation of digital IDs can streamline compliance processes for financial institutions. Regulatory requirements surrounding Know Your Customer, KYC, and anti-money laundering, AML, mandates often require thorough and time-consuming identity verification processes. By adopting digital ID systems, banks can enhance their compliance efforts, ensuring that they meet regulatory standards while minimizing operational inefficiencies. This not only protects the bank from potential penalties, but also allows supervisors and regulators to focus on monitoring larger anomalies without getting bogged down in repetitive verification tasks. The impact of digital IDs extends beyond individual financial transactions. It influences the broader financial ecosystem by enabling new, innovative services. As the barriers of traditional identification practices lower, the door opens for fintech companies to develop new products and services that rely on seamless identity verification. For instance, applications for personal loans, peer-to-peer lending platforms, or even investment services can become more accessible to individuals who may have previously struggled with traditional banking requirements. The resulting increase in financial inclusion is a powerful positive consequence of embracing digital ID systems. In addition, the global effect of adopting digital IDs cannot be overstated. In many regions, especially in developing countries, access to banking services remains limited, largely due to inefficient identification processes. By leveraging digital identities, financial institutions can expand their reach, allowing more people to access necessary financial services. This aligns with a growing global emphasis on financial inclusion, where offering services to underserved populations is increasingly recognized as both a moral imperative and a business opportunity. Companies that take an active role in this space often gain loyal customers who value accessibility and security, further enhancing their market position. The proactive approach outlined by the use of digital IDs in financial services can help create a more resilient financial ecosystem overall. Reducing fraud not only protects consumers but also helps stabilize the financial system and minimize potential losses for institutions. As financial institutions increasingly embrace technology, they create a solid foundation for the future, where proactive risk management becomes the norm rather than the exception. As this trend continues to evolve, the landscape of identity verification will likely see even more advancements. Artificial intelligence and blockchain technologies stand to revolutionize the way identities are verified and managed. For instance, blockchain might enable decentralized identities, allowing individuals to control their data and share it securely without the fear of centralized data breaches. AI can enhance the ability to detect suspicious activity, leading to a more responsive and agile financial system. As we reflect on the transition toward digital IDs in the financial sector, it's evident that the benefits extend well beyond mere fraud prevention. Enhanced security leads to improved customer experiences, greater inclusion in financial services, and an overall boost in consumer trust. Financial institutions that successfully navigate this transformation will not only mitigate risks but also position themselves as leaders in an increasingly competitive market. For customers, the proactive measures taken by financial institutions to integrate digital IDs into their operations should be seen as a positive development. Individuals should feel empowered, knowing that their financial institutions are actively working to safeguard their identities and financial assets. As the landscape continues to evolve, there's an opportunity for consumers to engage more deeply with digital financial solutions, fostering a more interactive and secure relationship with their banking services. In summary, the The synergy between digital IDs and financial services represents a promising evolution in the fight against fraud. As financial institutions enhance their security measures through collaboration with tech companies, the benefits to consumers and the overall financial ecosystem are profound. News number 4. The recent surge in Grid Dynamics shares following its announcement of inclusion in the S&P Small-Cap 600 Index is an exciting development not just for the company but also for investors and industry watchers alike. This milestone serves as a significant validation of Grid Dynamics' growth trajectory, financial stability, and increasing relevance within the technology sector. For many, this news feels like a well-deserved recognition of the hard work and dedication that has positioned Grid Dynamics as a noteworthy player in the competitive tech landscape. Joining the S&P Small-Cap 600 is a prestigious achievement for any company, particularly for a tech firm like Grid Dynamics, which focuses on digital transformation and technology services. The Small-Cap 600 is a broad index that represents a range of sectors, but being included signifies that Grid Dynamics has met specific criteria related to market capitalization, liquidity, and financial viability. This makes the inclusion a powerful endorsement of its operational strength and growth potential, not just in the eyes of the company's current stakeholders, but also as a signal to potential investors. The immediate market reaction, an uptick in share price, highlights investor confidence, which can be infectious. When a company's stock is recognized on a prominent index, it often attracts attention from institutional investors, whose participation can drive further demand for shares. These investors typically seek opportunities that are considered stable and growing, and Grid Dynamics' inclusion places it on the radar of portfolio managers who might not have previously considered the company as a viable investment opportunity. The anticipation around this inclusion isn't just about stock price movements. It also reflects broader themes within the tech sector. Grid Dynamics is known for helping companies leverage technology to enhance their operations and drive more effective innovation. Their services encompass everything from cloud migration to artificial intelligence solutions, helping organizations successfully navigate the digital landscape. Given the increasing importance of technology across all sectors, Grid Dynamics is well positioned to capitalize on the growing demand for tech-driven solutions. With a momentum shift can often come increased visibility. Institutional investors who manage large portfolios are typically drawn to S&P Index members because these firms have been vetted for resilience and growth prospects. This means that now, more than ever, Grid Dynamics is likely to attract fresh capital from these investors, further solidifying its position in the market. It's conceivable that this influx of institutional investment will not only bolster the company's stock price, but also provide the resources necessary for Grid Dynamics to scale its operations and pursue new ventures more aggressively. Moreover, with the backing of institutional investors often comes greater scrutiny and higher expectations regarding performance and governance. Grid Dynamics may find itself under more pressure to demonstrate continual growth and profitability, which can be both a challenge and an opportunity. The increased accountability means that the company will need to focus on sustainability in its growth strategies, ensuring that its business practices align with the interests of its larger shareholders, all while maintaining agility in a rapidly changing tech environment. Grid Dynamics has also worked to establish a reputation for delivering high-quality solutions tailored to meet the diverse needs of its clients. This dedication to excellence can help maintain customer loyalty, which is essential for ongoing revenue growth. As the tech landscape evolves, clients are not just seeking vendors. They desire partners who can support their strategic goals through innovative solutions. Grid Dynamics has a chance to strengthen these partnerships further as it gains more recognition and credibility in the market. An important consideration in the wake of this announcement is how Grid Dynamics might leverage its newfound status to accelerate its growth trajectory. Inclusion in the S&P Small-Cap 600 could empower the company to explore new markets, seeking opportunities both domestically and internationally. To appeal to a broader audience may open doors for strategic collaborations and partnerships, giving the firm access to new technologies, markets, and customer bases. With larger, well-established companies often looking for ways to innovate and evolve, Grid Dynamics could find ample opportunities to align itself with these organizations. Furthermore, Grid Dynamics leadership will need to be proactive in communicating its strategy and vision to the marketplace and its investors. Clear articulation of growth strategies can help build confidence among stakeholders and solidify the company's image as an innovator in the tech sector. Keeping a pulse on market trends and actively engaging with its clients and investors will be vital as it navigates this new chapter. Transparency regarding performance metrics and future plans will help foster a stronger relationship with both existing shareholders and potential investors entering the fold. Another critical aspect of this inclusion is the potential impact on talent acquisition and retention. As Grid Dynamics solidifies its reputation in the market, the company will likely find itself in a better position to attract top talent. The tech industry thrives on innovation, and having a skilled workforce is critical to staying ahead of competitors. By being included on a prestigious index, Grid Dynamics can market itself not only to investors but also to prospective employees, highlighting the benefits of joining a company that is growing, stable, and recognized for its contributions to the industry. This not only contributes to talent acquisition, but also helps in retaining existing staff who may feel more motivated knowing they are part of a successful, reputable organization. Additionally, the ability to attract institutional investors often translates into more long-term stability for the company's stock price. This stability has many benefits, including easier access to future funding if needed. Should Grid Dynamics decide to raise capital in the future, it may do so with greater ease and potentially on more favorable terms. The presence of a strong institutional backing can serve as a vote of confidence that the firm has a solid foundation upon which to build its future. As new growth opportunities arise, Grid Dynamics may also consider strategic acquisitions or investments in complementary technologies. The tech sector is rife with potential synergistic partnerships that can propel growth and innovation. Whether that means acquiring a startup specializing in cutting-edge artificial intelligence solutions or forming a joint venture with another tech company to explore new markets, the possibilities are vast. Being included in the S&P Smallcap 600 affords Grid Dynamics visibility and credibility, making it a more attractive partner for such endeavors. Looking ahead, the journey for Grid Dynamics is just beginning following this important announcement. The combination of increased attention from investors, a stronger reputation in the market, and enhanced capabilities for growth positions the company well to navigate not only the immediate implications of its new status, but also the broader trends shaping the technology landscape in the coming years. News number 5. After the Christmas holiday, the U.S. stock markets have displayed a notable sense of caution, with minimal movement observed in the major indices. This restrained activity comes as investors grapple with a combination of economic data releases and ongoing geopolitical tensions that are shaping market sentiment. As we approach the end of the year, it's an interesting time for traders and investors alike, as they reassess their positions and strategies heading into the new year. The holiday period often brings a lull in trading activity, as many market participants take time off to recharge. However, the post-Christmas market behavior this year has been particularly reflective of broader concerns affecting investor confidence. With economic indicators coming into focus, traders are keenly analyzing data that could provide insights into the health of the economy and potential future trends. This careful scrutiny is essential, especially as we transition from one year to the next, a time typically characterized by speculation and adjustments in investment strategies. The limited movement in the stock markets can also be attributed to the cautious approach many investors are taking. They are likely weighing the implications of recent economic reports, such as employment figures, inflation rates, and consumer spending data. These indicators are crucial for assessing the overall economic landscape and can significantly influence market performance. For instance, if consumer spending shows signs of weakness, it could raise concerns about economic growth, prompting investors to rethink their positions. Geopolitical tensions are another factor contributing to the cautious sentiment in the markets. Events on the global stage can create uncertainty, leading investors to adopt a wait-and-see approach. Whether it's conflicts, trade negotiations, or policy changes in major economies, geopolitical issues can have ripple effects on market stability. In this context, investors are likely to remain vigilant, monitoring developments closely and preparing for potential volatility. As analysts predict continued volatility, it's essential for investors to consider how they can navigate these uncertain waters. One strategy might be to diversify their portfolios, spreading investments across various sectors and asset classes. This approach can help mitigate risk, especially in a climate where market movements can be unpredictable. By diversifying, investors can protect themselves from potential downturns in specific industries while capitalizing on growth opportunities in others. Additionally, staying informed about economic trends and geopolitical developments is crucial for making informed investment decisions. Investors who actively engage with market news and data releases are better positioned to adjust their strategies in response to changing conditions. This proactive approach can lead to more agile decision-making, allowing investors to capitalize on opportunities or shield themselves from potential losses. For businesses, the current market environment presents both challenges and opportunities. Companies operating in sectors that are sensitive to economic fluctuations may need to adapt their strategies to maintain growth. For instance, businesses in retail, hospitality, and travel might face headwinds if consumer spending slows down. However, companies that are agile and responsive to market conditions can find ways to thrive even in uncertain times. This might involve adjusting marketing strategies, optimizing supply chains, or exploring new revenue streams to offset potential declines in traditional areas. On the flip side, industries such as technology and healthcare may continue to see growth, driven by innovation and ongoing demand for digital solutions and healthcare services. Businesses in these sectors can leverage their strengths to capitalize on market trends, positioning themselves as leaders in their respective fields. For investors, identifying companies with strong fundamentals and growth potential can be a sound strategy during periods of market volatility. As we look ahead to the new year, the cautious sentiment in the markets may prompt many investors to reassess their long-term strategies. This is often a time for reflection and planning, where individuals and institutions evaluate their performance over the past year and set goals for the future. For some, this may involve reallocating assets, exploring new investment opportunities, or even adopting a more conservative approach to risk management. The potential for volatility in the coming months means that having a clear investment strategy is more important than ever. Investors should consider their risk tolerance, investment horizon, and financial goals when making decisions. Those who remain disciplined and focused on their long-term objectives are likely to weather the ups and downs of the market more effectively. Moreover, the current market dynamics underscore the importance of having a well-rounded understanding of both macroeconomic factors and individual company performance. Investors who take the time to analyze economic indicators, industry trends, and company fundamentals will be better equipped to make informed decisions. This comprehensive approach to investing can lead to more successful outcomes, particularly in uncertain market conditions. In addition to individual strategies, the collective behavior of investors can also influence market trends. As more investors adopt a cautious stance, it can create a feedback loop that reinforces market volatility. This is why sentiment plays such a crucial role in financial markets. Understanding the psychology of investing can provide valuable insights into market movements, helping investors anticipate potential shifts and adjust their strategies accordingly. As the new year approaches, the interplay between economic data, geopolitical tensions, and investor sentiment will continue to shape the landscape of the U.S. stock markets. For those involved in investing, whether as individuals or institutions, it's an opportunity to reflect on past experiences and refine their approaches for the future. The ability to adapt to changing conditions, remain informed, and maintain a long-term perspective will be essential for navigating the complexities of the market. Ultimately, while the post-Christmas period may exhibit limited movement, it serves as a reminder of the broader forces at play in the financial world. The cautious approach many are taking reflects a desire to be prepared for whatever lies ahead, whether that means capitalizing on emerging opportunities or protecting against potential risks. As we enter the new year, the landscape remains dynamic, and those who are proactive, informed, and adaptable will be best positioned to thrive in the ever-changing world of investing. This period of reflection and reassessment can set the stage for a successful year ahead, where opportunities abound for those willing to navigate the complexities of the market with diligence and foresight. If you find this video helpful, please like, follow, subscribe, and share it with your friends and family. At Impact Solutions, we offer business consultation and growth strategy services to help you scale financially. Visit our website to book an appointment. The link is in the description. Take care. Goodbye.